It looked like the perfect deal. A brand new 2-bedroom flat, 5 minutes from the station. Help to buy approved, future-proofed, and marketed like a dream. The couple felt lucky. They signed the papers, locked in a mortgage for $280,000, and walked away believing they had beaten the system. But now the real price is showing. Their fixed-rate deal ends in 8 months. Their lender has already warned them. Their new monthly payments will jump by over $400. And the flat itself? It's now worth $245,000. They're trapped. Negative equity, no remortgage options, and no buyer willing to touch it unless they take a huge loss. And the worst part? They're not the only ones. Right now, millions of homeowners across the UK are walking toward the same cliff. They don't realize it yet, because everything looked safe just a few years ago. But today, what looked affordable is becoming unaffordable. What looked stable is becoming risky. And what looked like an investment is quietly turning into a liability. Between 2020 and 2021, the UK handed out cheap money like sweets. 2% mortgages, 5% deposits. 95% LTV deals. People believed they could lock in safety for 5 years, maybe even longer. But no one asked the bigger question. What happens after the deal ends? Because between now and the end of 2026, over 2 million households will exit their fixed-rate mortgages. And when they do, they won't see 2% or 3%. They'll see today's rates, double, sometimes triple what they used to pay. Let's put that into numbers. A 300,000 SEK mortgage at 2% costs roughly 1,070 per month. At 6%, that same mortgage becomes $1,730 per month. That's $700 extra every month, $8,400 a year, evaporating instantly. For families already stretched by rising bills, childcare costs, car finance, groceries, and the general cost of living, this isn't just a problem. It's a breaking point. Now imagine this same shock hitting millions of households at the same time. This isn't just one unlucky couple. It's an entire generation of buyers caught at the peak of the market, now waking up to the reality that they bought at the most expensive moment in modern history. But the real danger isn't just higher payments. The real danger is negative equity. Most people don't realize how close they already are. Here's the simple version. You buy a flat for $350,000 in 2021. You put down a 10% deposit, $35,000. Your mortgage starts at $315,000. Fast forward to 2025. The market slides, and your property value falls to $310,000. But your mortgage balance is still $312,000. You now owe more than the property is worth. That's negative equity. You can't sell. You can't remortgage, and your lender won't touch your case because the loan-to-value is too high. So you're stuck, hoping prices rise again. But what happens when hundreds of thousands of people are stuck like this? The housing market freezes. No one moves up. No one moves down. And new buyers don't want to buy because they're watching early buyers get financially crushed. A frozen market is dangerous. Because if prices fall even a little more, just 5%, we could see over 1 million UK households fall into technical negative equity by 2026. And that's only one piece of the puzzle. Another pressure point is landlords quietly leaving the market. In 2024, nearly 20% of UK landlords sold at least one property. And for every 10 landlords who sold, only 4 bought new ones. That's a massive net loss in rental supply. Why are they selling? Because the numbers no longer add up. A property that once rented for $1 in $100 with a $600 mortgage now has a $1,000 mortgage. Maintenance costs are up, insurance is up, taxes are up, regulations are stricter. Evicting tenants is harder. And new bills, like the Renters Reform Bill, make renting even more complicated. So landlords are quietly escaping before things get worse. Meanwhile, new builds, those shiny, perfect homes marketed as affordable and future-proofed, are turning into a nationwide ticking time bomb. Most new builds are overpriced by 10% to 15% because developers inflate prices with incentives. A flat listed at $400,000 may really be worth only $350,000. Once buyers try to sell, they discover no one is willing to pay the inflated price they paid. Thousands of Help to Buy loans are now approaching repayment. And many owners are realizing the scheme didn't save them money. It trapped them in overpriced homes with growing debts tied to market value. Even worse, some owe a percentage of the sale price, not the original loan. So selling at a loss can still leave them with debt. And then there are renters. Rents are rising faster than ever. London tenants are seeing increases of 20% in a single year. Across Manchester, Birmingham, Bristol, and Leeds, the story is the same. Many renters think rising rents mean it's time to buy. But high prices, high interest rates, and stricter lending rules make getting a mortgage almost impossible for first-time buyers. They're trapped paying higher rent, saving less, and watching property prices, even if falling, remain out of reach. This is why experts warn that an entire generation may be locked out of home ownership permanently. The irony? Some renters who waited may now be in a better position than first-time buyers who bought too soon. Because timing matters more than ever, and rushing in during a peak market can be catastrophic. The UK housing market isn't crashing overnight. It's changing slowly, quietly, but with serious consequences. The decisions made by buyers in 2020, 2021, and 2022 are only now coming due. And for those who borrowed heavily with low deposits, 2025 is the year of reckoning. By the end of 2026, hundreds of thousands of fixed-rate deals will expire. With rates still above 5%, affordability will become a real crisis for many households. If prices fall just 5% more and rates remain high, nearly 1 million households could enter negative equity. And that's not just a housing slowdown. It's a slow-motion crisis affecting millions. Governments may intervene with schemes, stimulus, or new help-to-buy programs. But these often raise prices, trapping new buyers at inflated levels, right before the next market cycle repeats. Regret won't just hit those who bought at the peak in 2021, 2022. It will hit anyone who buys too soon without understanding the real market forces at play. So what does this mean for you? If you're a homeowner, the next few years will test how well you understand your mortgage and financial limits. If you're renting, it's not about jumping in fast. It's about preparing smart. And if you're an investor, this cycle is creating pain, but also rare opportunities. Because in every regret-filled market, someone who saw it coming will move differently and profit. Timing matters, numbers matter. And right now, more people are getting trapped than winning. But there's another group quietly heading for the exits. First-time buyers who bought at the peak. Many were lured in by low deposits, government schemes, and the promise of rising house prices. They believed they were investing in their future, but the reality is harsher. Properties bought during 2021-2022 are now often worth less than the original purchase price. Fixed-rate deals are expiring, and interest rates are more than double what they used to be. For some, monthly mortgage payments will jump by hundreds of pounds, crushing household budgets. Negative equity is no longer a theoretical problem. Thousands of homeowners now owe more than their homes are worth. They can't remortgage, they can't sell. And many have little choice but to stay put and hope prices recover. A recovery that could take years. This isn't just a story about individual hardship. It's about a market-wide freeze. When so many people are trapped, the entire housing ladder locks up. No one can move, no one can upgrade, and first-time buyers are left on the sidelines. Meanwhile, rents continue to rise. Tenants are paying more, saving less, and watching as house prices, even if falling, remain out of reach. In London, some renters are seeing 20% increases in just a year. Outside London, cities like Birmingham, Manchester, and Bristol are facing similar trends. For those waiting to buy, the situation is a paradox. The market seems cheaper in some areas, yet higher interest rates and stricter lending rules make mortgages harder to get. Rushing in without proper planning could mean buying at the wrong time, repeating the mistakes of 2021 buyers. Investors are also adapting. Some see opportunities in a market where prices are softening and landlords are leaving. But they also recognize the risks, regulatory changes, higher mortgage costs, and uncertainty about demand. Only those who understand the numbers, timing, and market cycles can navigate successfully. So, what lessons emerge from this evolving crisis? Timing matters, numbers matter. Understanding your financial limits matters more than ever. For homeowners, it's about knowing your mortgage and planning for rising rates. For renters, it's about preparing wisely and not rushing into buying. For investors, it's about spotting rare opportunities while avoiding traps that catch the unwary. The UK housing market isn't collapsing overnight. It's shifting, quietly, but with profound consequences. The coming years will determine who survives, who prospers, and who faces regret. And for millions of people, 2025-2026 will be the moment of truth. The deals made during the easy money years are ending, and the consequences of timing, affordability, and market realities are finally coming due. In this slow-motion crisis, Some will adapt, some will suffer, and some will see opportunity. The key is preparation, awareness, and understanding the forces shaping the UK housing market today. Because in every market cycle filled with regret and pain, there are always those who see it coming and move differently. And finally, let's talk about the real long-term impact. The ripple effects across the entire UK housing market. When millions are trapped in negative equity, it doesn't just affect individual households. It affects the whole economy. People can't move, can't upgrade, and can't spend freely because a huge portion of income goes to mortgages. The housing ladder grinds to a halt, and first-time buyers are left watching from the sidelines. At the same time, the exodus of landlords reduces rental supply. Fewer rental properties mean higher rents, creating additional pressure on households already struggling with inflation, energy costs, and everyday expenses. Young people and low-income families face a double squeeze, high rents and barriers to buying. Meanwhile, developers continue to build new homes, but many are overpriced. Help to Buy and other government schemes are ending or changing, leaving buyers exposed to high costs and potential debt. Those who rushed in during the boom years are now realizing the harsh reality. The promise of easy home ownership was temporary. Government intervention may help some people, but it cannot fix the structural issues in the market. Stimulus programs and new schemes often inflate prices further, repeating the cycle for the next wave of buyers. Timing and strategy matter more than ever. Rushing in without understanding the risks can be catastrophic. So what can you do? If you're a homeowner, review your mortgage. Know when your fixed rate ends and how rising rates will affect your payments. Plan ahead. Consider options like overpayments or alternative financing before it's too late. If you're renting, don't rush. Assess your savings, job security, and realistic affordability before committing to a mortgage. Rising rents may push you to buy, but make sure the timing and numbers make sense. If you're an investor, look for opportunities, but be cautious. The market is changing, rates are high, and regulations are evolving. Understanding the numbers and timing is critical to navigating this complex environment. The UK housing market isn't collapsing like 2008. It's evolving slowly, quietly, but with real consequences for millions. Those who bought too early may face negative equity and higher payments. Those who rushed into new builds may find themselves over-leveraged, and renters may find themselves paying more while waiting for the right moment. But there's also opportunity. In every cycle of regret, there are people who see the trends and act differently. They understand timing, affordability, and risk, and they position themselves to benefit while others struggle. 2025-2026 will be the true test. Millions of mortgage deals are ending, interest rates remain high, and affordability is a real challenge. The choices made now, whether to buy, hold, rent, or invest, will shape financial futures for years to come. In the end, the UK housing market is a lesson in patience, preparation, and understanding. Those who respect the numbers, the timing, and the risks will survive and even thrive. Those who ignore them may face regret, financial strain, and a harsh awakening to the realities of the market. The story isn't over, it's only just unfolding. And for millions of people, the next few years will be the ultimate measure of foresight, planning, and resilience in the face of a shifting housing landscape.